Hi, today I want to dive deeper, look into beta. So beta is used very frequently in the financial world, especially for the portfolio managers. If you want to pick a mutual funds, or even you want to pick a individual stock, they often have a beta associated with them. So, what is beta? They often been said it's a measure of the volatility or systematic risk of the security of the portfolio compared to the market as a whole. What does this really mean? First, let's see, the beta, how beta is calculated. This is formula to calculate beta. So basically, let's say this is the individual stock, the beta I, right? Is equal to the individual stock and the covariance of the individual stock and the market. Then divided by the market standard deviation. Because the covariance, the individual stock and the market is equal to coefficient correlation, the individual stock of the market and the market times the standard deviation of the individual stock, then times the standard deviation of the market. So that way you can get the beta formulas is equal to correlation coefficient times the individual stock standard deviation divided the market standard deviation. So I like this formula better. You will understand, beta very well. Use this formula. Here's the example. This is the annual return, last 5 years annual return of the S&P 500 and the Best Buy. So this is annual returns. When we look at the Best Buy and compare to the S&P 500, so we want to know the Best Buy beta. What's the Best Buy beta? When we compare to the S&P 500, in this case, S&P 500 beta is equal to 1. So based on the this S&P 500, then we can calculate the beta of the Best Buy. Okay, in order we calculate the beta, so we needed all those information, which is the mean and standard deviation of the S&P 500, the mean standard deviation of the Best Buy. So once we have those information, we can calculate beta. Beta is, we have the correlation coefficient here, then it's the correlation coefficient, then times the Best Buy standard deviation divided by the market standard deviation. If we just purely look at this standard deviation, so say Best Buy standard deviation is 3 times of the market. What does this tell you? They tell you Best Buy is 3 times more volatile than the stock market if you invest in the Best Buy. So then this 3 times volatility, then is what's the percentage of this volatility is contributed by the overall economy. And so this is the correlation coefficient is coming into play. So this correlation coefficient basically tell you, say, 86% of the Best Buy returns that is correlated with the stock market. So that way will tell you, okay, the Best Buy have 3 times of the volatility compared to the stock market, and 3 times of those, 86% is affected by the overall economy. So that's why I give you 2.6 2.6485, this is the beta. So that's why saying the beta is measure the systematic risk. Systematic risk means the overall economy risk, which is something you cannot avoid it. When, let's say, when the economy go in recession like 2008, 2009, even the current coronavirus situation. So that's called overall economy risk, systematic risk. That's why they say beta is the systematic risk measurement. So to interpret the beta, so usually we say, they say Best Buy have a beta 2.645. What you quick interpret is say, if the S&P was expected to return 10%, Best Buy would be expected to return 26.45%. So if the Best Buy was expected to return negative 10%, Best Buy would be expected to return negative 26.45%. So that's just a quick. So use the beta to predict individual stocks return if it give you the market return, right? But really, how accurate this is. So based on those data, we can this basically is a linear regression. We can do a linear regression analysis. So we get this scatter plot, then get best fit regression line. This is the regression line here. So my title is beta is equal to the slope of the regression line. Yes. So what we had the beta beta before is this is the beta. This slope is beta. So the things we want to know, because based on the data, then we coming up, this is the best fit line. So this line is the best to predict the S&P 500 return and the Best Buy returns. So this is the best line to predict. So if we say S&P 500 get a 10% return, so we just plug the 10% to the equation, we'll get Best Buy will get a 24.407% of return. However, before we use beta, we get a 26.45%. So this is a little off. Then when I have here, will tell you that when you use beta, just simply use beta to predict the Best Buy return, you really use the line of y equal to 2.657 times x. There's no y interception. So this line is not a good prediction, because we do linear regression analysis will coming up. This is the best fit line. This is the better line to predict the Best Buy returns based on the standard S&P 500. And so just keep in mind, if you do use it, because it's being frequently used, people use the beta in that way, just to say, oh, the market go up 10%, so then the this stock go up, it's beta times 10%. So that's just to keep in mind that just the approximate. You can see it's close, but it's not accurate. It's not very accurate. So then another thing here, coming play, they give you a R-squares. Basically, this R-square is pretty high. It's about 75%. So which tell you Best Buy last 5-year return is pretty much correlated with the S&P 500 return. So this correlation exists. So this linear regression, this regression line is a good prediction. So you even can use beta to predict their returns. So that's because they have a high correlation. So R squared is greater, is equal to 75%. So this is great. So in this example, we use different stocks. This is stamp, STMP. This is the stamp stock. So I want to show you. This is the stamp last 5 years return compared to S&P 500 return. So once we get this information, we can get a linear regression to prediction. So they do give us a line, right? So this is still the beta. This one beta still is equal to this slope. Then they give us a R square. You can see this R square I have here is 5.9%. What does this tell you? This is basically tell you the stamp last 5 years return is not really correlated with the S&P 500 return. So you can clearly see all the dot with the line here. They just all over the place. This line not really protect the their relationship. They have not much relationship going on here. So that's why I tell you R squared is very, very low. Say these two variables are basically not correlated in a linear way. So that's why when the R squared is so low, then you cannot use beta. So here they do give you a beta 1.3. You cannot say S&P 500 go up 10%, then the stamp will go up 1.3. This is just not true, because if you plug the number in this line, well, it's because this line does not predict the relationship S&P and the stamp, so that you cannot use beta to in this way. So anyway, conclusion, just when you use beta, just make sure the R square is greater than 70. That's in the financial industry, we have 70 rules. When R square is greater than 70, you can use the beta, because that linear relationship exists. So beta is only approximation. Yes, we tell you if you want to use beta to predict the return, that's just the approximate return. So it's not that accurate.